So if we're looking at an inflation print that is less than what the average economist surveyed, why are the markets giving us nothing?
Well, I think we're seeing two things. I mean, we're certainly seeing progress on the inflation front. That's good news. It was generally widely expected. I think what the market is grappling with is you're starting to see greater stickiness. I mean, at the end of the day, it's not great solace that we have core inflation above 5%. Now, the near-term momentum may be slowing, but it says to me the Federal Reserve is not done, and I think that's what the market is trying to disentangle.
Well, disentangle, but I'm also curious about what's driving the actual inflation story. Because look, when we started talking about inflation circa 2021, it was mostly a commodity-driven move. Now you're seeing it mostly in shelter costs. What's next?
Well, I think we're seeing it again. Even Chairman Powell, highlighted the three areas. The first component you mentioned is the supply chain. It's the good prices. That has generally run out of the system. The housing has been well documented. That will start to slow. We start to see evidence of that today. It's the third bucket, which is the most important bucket, and that's tied to the labor market. That's core services prices. It has a high relationship to wage growth, which is why the labor market, it always comes back to the strength of the labor market, and that's where we're going to see the stickiness. I mean, we will get down to 4 to 3.5 pretty easily just by pure math, but it's beyond that point that it's going to be that last mile of inflation is going to be a little tricky.
Well, it's interesting that you say it's a little bit tricky, because then you have to take a look at the bond market here. And of course, we can tap into your markets knowledge as well, Joe, and look at a bond market. Yields actually came down pretty significantly. I think we're looking at 345 now on the 10-year yield, but on the headline inflation print itself, they came down significantly. What is this bond market telling you?
Well, the bond market's saying two things. One, just by the inverted yield curve, which has been for more than a year, that a recession, even if it's mild, is coming. And secondly, the Federal Reserve is going to switch gears very quickly and start cutting rates before the end of the year. On that second point, I still remain very skeptical if I'm right on the stickiness of inflation. I think what is different from the past several cycles is that the Fed will not have the sort of latitude to cut rates, given inflation is still well above target. That is the area of disagreement in the bond market. The latter acceptance of the Fed cutting rates very soon, I think, is propping up some of the risky parts of the market.